Good afternoon, grade 12s. Welcome to our class. This is our 18th lesson. And for those who are just joining us today, welcome. We are still looking at investment securities, but we're looking at part 4. Yesterday, we covered up until, just check now. All right, boys and girls, sorry about that. Okay, so we're still looking at the forms of investment. Yesterday, we did explain that there are 4 different types of investments: your government, or you can, if you don't want to call it your government, you can call it an RSA, retail savings bond, your unit trust, your shares, and your fixed deposit, basically, right? So I want us today to look at the impact on these 4 forms of investment: your positive impact and your negative impacts, right? Before we start with those, I just need my highlighter. All right, I do have my highlighter now. So now, let's start with your government retail bonds, or you can call them your RSA retail savings bond, or you can just call them your savings bond, basically. Let's look at the positives about your government bonds. The positives about the government bonds is that it is a guaranteed return, as the interest rate is fixed for a whole investment period. A good thing about a government bond is that they don't have a variable interest, they've got a fixed interest, meaning that if you were to enter to a bond, right? If you are paying 4,000 per month, you can pay 4,000 for the rest of 20 years. If your bond is for 20 years, if your bond is for like 15 years, you will pay 4,000 up until the 15th year, right? So that's a good thing about what your government bond, that the interest rate is fixed. That's a nice thing. There are other bonds where you enter them, where you find out that the interest is variable, that when the rent goes up or goes down, the interest will be affected. But good thing about the government bonds is that the interest is fixed. Like even after 20 years, you'll be paying the very same amount, basically. Also, under your government bond, you must know that your interest rates are market related and attract more investors. Their interest rates are market related. Sorry about that. I'm looking for my highlighter. So, interest related. Interest can be received twice a year. So, interest for bond can be received twice a year. Is usually higher than other fixed deposit. So, it is higher than other fixed deposit. Also, your retail bonds are listed on your capital bond market or on your JSE, of which is your Johannesburg Security Exchange, or you can say Johannesburg Stock. Also, your government low risk or safe investment, right? As it is invested with the South African government, which cannot be liquidated. We know that our government, the South African government bond cannot be liquidated. Does it make sense? No charges, cost, commission payable on this type of investment. So under government bonds, there are no charges at all. There is no your what you call your what do they call this name? Transfer costs, basically, when you enter to your government bond, right? But if it's another bond, you will pay your transfer cost, basically. Investment may be easily accessible as the cash may be withdrawn after the first 12 months, right? And also, it is affordable type of investment for all levels of income earners, including pensioners. So even pensioners, they can enter to a government bond. So everyone is more than welcome to do the government bond, right? Whereas other bonds, there are restrictions. They'll be saying to you, if you earn so much per month, you can qualify and stuff like that. But for a government bond, boys and girls, everyone does qualify. Retail bonds are easily, conveniently obtained electronically from any post office directly from your national treasury, right? Also, investors younger than 18 years, those who are regarded as minors, may be invest in, with the help of your legal guardian, would encourage savings from a young age. So basically, what do they mean? As you guys are younger than 18, some of you are already 18, that's a good thing. But some of you are less than 18, some of you are 17, 16, going downwards, You may enter to a bond, but you must get help from a legal guardian. It can be your mom, your dad, your grandparents, your aunt, your uncle, right? Now, let's look at the bad things about government bonds. We know that these government bonds cannot be seized to banks as security for obtaining loans, right? So very, very, very important, right? Also, a minimum of 1,000 must be invested, which may be difficult for some small investors to accumulate, right? So remember, a disadvantage is that you can only invest the minimum that you can invest to a government bond. It can be 1,000. I mean, if you want to invest in 1,000, it's just gonna take time for you to get your returns. 1,000, it's investment. It's not so much. Unlike other bonds, they will tell you that the minimum amount that you can put in for this type of bond, it's maybe 10K. Others are even 16K. So it is very important to understand. Retail bonds are not freely transferable amongst investors. So these government bonds, they are not easily transferable to each other. Investors need to have a valid SA identification or should be older than 18 months, which may discourage foreigners or young people to invest. So in order for you to invest in a government bond, you must be a South African citizen. Right. So what does it mean? It means that it will disadvantage some of our foreigners, people who don't have SA identification, and also those people maybe who come to reside in South Africa from other countries and they end up being South African citizens. They still have to go through the Home Affairs process in order for them to get there the RSA ID, then apply for government bonds. Penalties are charged for early withdrawals if savings is less than 12 months old. So now if you withdraw early, you will be charged penalties in your government bonds. All right, guys, those are your government bonds, and I hope you understand them by now. For now, let's look at the impact on unit trusts. Let's look at the impact on unit trusts. This is another type of investment. Now, a unit trust, let's look at the positives and the negatives when it comes to a unit trust. A unit trust, positive things or positive pointers is that it is managed by fund managers who buys shares on the Johannesburg Stock Exchange, your JSE. Easy to cash in when an investor needs money. A small amount can be invested per month, generally beats inflation on the medium or long term. Safe investments, as it is managed according to the rules and regulations. The investors has a variety to choose from and a wider range of shares from lower to higher degree of risks. Easy to invest in as the investors simply complete a few relevant forms or invest online. Fluctuations in unit trust rates of return are often not so severe because of diversity of the investment fund. Offer competitive returns in the form of capital growth and divided distribution. Also, boys and girls, you need to know that your unit trust, their fund managers are knowledgeable, are they, meaning that they are experts, and you can also rely on them, and also they are trustworthy as they are required to be accredited to sell the unit trust, basically. So that's a good thing, or that those are the positives about the unit trust, that whoever the fund manager is knowledgeable, he or she is an expert, he or she is reliable, he or she is trustworthy. Now let's look at the downfalls when it comes to the unit trusts. So what are the negatives when it comes to unit trusts? So we know that the share price may fluctuate, meaning that it can go up or down, of which that does not put us in a good condition or situation. Unit trusts are not allowed to borrow, therefore it reducing the potential returns, basically. All right. Sorry about that, guys. So we were looking at the downfalls when it comes to your government bonds. I mean, to your unit trusts. Your negative about your unit trust. We said the share price may fluctuate. Also, unit trusts are not allowed to borrow, therefore reducing the potential returns. Not good for people who want to invest for a short period of time. Remember, if you want an investment in a unit trust, you cannot expect to put your money in 2020 and expect to get it in 2021. Those are your long-term investments, I mean to say, your unit trust. Most of the people, they enter unit trust while they're still young, for pension. Some people join unit trust while they're still working. Then once they go to their pension, they can withdraw that money. Other people, they do unit trust for their children while they are working. They I mean, let's say if they die, or some people, they do unit trust when they what you call, while their children are still young. Let's say while a child is still in grade R or grade 1, or some parents, when the child is still pregnant, I mean when the parent is still pregnant, they open unit trust for their children, so that after 21 years, when they want to go to varsity, they can always pay those fees. Also, it's not good for people who want to avoid risks at all. So if unit trust is good for risk takers. So remember, guys, one of the investor, one of the skill for investor is that you need to be a risk taker. Guys, if you are not a risk taker, if you're an entrepreneur or an investor, you won't cope. So as an entrepreneur, or as an investor, or as a businessman, you always need to take risks, because that's one skill that you need to have. And that skill will make you grow also as an individual, because I'm telling you right now, majority of the businesses are booming out there, are doing so good, are doing so great, because those people are risk takers. Also, If a blue chip companies do not continue on their growth path, the growth of unit trust will also be affected and will not be rendered the expected returns. Also, guys, the bid or ask prices. Remember, where do we get our bid or ask prices? Through what you call this auction, isn't it? The prices exist with price that you can buy a unit for usually higher than the price you can sell for, making an investment less liquid. Right. And now let's look at another type of investment. It's your ordinary shares, right? It's your ordinary shares. Let's see another alternative of investment. It is ordinary shares. So we've spoken about unit trust. We have spoken about government bonds, right? All those are form types, are your forms of investments, isn't it? Now I want us to look at ordinary shares. Now, with your ordinary shares, basically, guys, we know that some people they invest in shares. They buy shares at the age of 20. Other people they buy shares at the age of 30, and they can accumulate those shares maybe after 20 years. And once you buy shares in a certain company, you'll be regarded as a shareholder, right? Now, the shares that you buy, remember also they can fluctuate, right? So, but I mean, we'll look at that in when we go to negatives about your shares. But remember that how do you get your returns on shares? So you're going to get your return through a dividend. So the returns that you're going to get through your shares is a dividend. So meaning that's a profit that you gain. It's called a dividend through shares, right? So good things about shares is that they can be freely transferred or traded on JSE, right? So they are being traded on your Johannesburg Stock Exchange, and we know that shareholders' liability to the debt of the company is limited to what was invested, or shareholders have the limited liability for company debts, right? Then shareholders have voting rights at an AGM. What is an AGM? An annual general meeting. So if you're a shareholder for certain company, you have a right of voting in your annual general meeting. Remember, the annual general meeting, your AGM, is the meeting that most of the companies are hosting it once a year, normally towards the end of the year, to announce, also to announce new things, to appoint new directors also. Investing in shares provides protection against inflation. So when you invest shares, you're actually protecting yourself from the rise in inflation, because once you buy shares in, let's say, in 2004, so the inflation, your shares won't be affected by inflation, because we know that inflation only affects the increase in prices. Investing in shares can provide solid returns at the retirement age. So when you invest shares, you can get your returns at the retirement age, whether at the age of 65, 70, whenever you want to retire from your own work. Then we've got the rate of return on investment. That's your ROI. It is linked to the performance of the company, the ROI, right? Your ordinary shares are usually cheaper than your preference shares on the open market. Remember, we've got two types of shares: your ordinary shares capital. Remember, ordinary shares capitals are those shares that can be sold at the public. Anyone can buy those. However, your preference shares is for your first preference, right? Normally, it can be sold at the existing shareholders and stuff. Holding a higher number of shares may result in a higher potential of dividend payout. Remember, the more shares that you buy, the higher dividend payout you're going to get. Now, let's look at the negatives or disadvantages about ordinary shares. We know that shareholders may receive less dividends or no dividends when the profits are low. Remember, when the profits are low, remember, they can only pay you dividends based on what? On what profits the company made. So if the company made less profits, the dividends for that particular year will be less also. Also, another bad thing about your ordinary shares is that companies have no legal obligation to pay dividends to shareholders. So companies, they don't have legal obligation, meaning they are not obliged to pay those dividends now and then. So it's up to them if they've made a profit or loss. Remember, they can only pay dividends only if they've made a profit. The risk may be high. I did mention that. As a result, as an investment may be lost when companies are liquidated. Dividends declared may be determined by the management directors of the company or business. Right. Now, another one is the impact on fixed deposit. That's another type of investment or a form of investment, your fixed deposit, right? So also here, boys and girls, we need to look at the bad things and the good things when it comes to your fixed deposit. So now, what are the positive things we know? Let's just explain a fixed deposit first. Remember a fixed deposit, let's say I've got 100,000 and I want to go invest it, right? And I'm like to the bank, I can only take it after 15 years. So that deposit is fixed. Other investments, you tell the bank that you'll be putting maybe 1,000 rands every month. But a fixed deposit, it's a once-off investment. You take a lump sum of money, you go put it at the bank, right? And remember, if you do a fixed deposit, the interest for fixed deposits is always high because you tell the bank that you need that money maybe after 20 years or after 15 years, right? So the bank will keep that money for you without any interference. There is no 32 days notice for fixed deposit. You can't withdraw it at any time. You can only withdraw it after 15 years. Does it make sense, boys and girls? So the interest is earned at a fixed rate regardless of changes in the economic climate. Also, the period of investment can be over a short or medium long term. The investors can choose the investment period that suits them. As I said to you, can be 10 years, 15 years, 20 years, or even 40 years. It's up to you. Principal amount plus interest and is paid out on the maturity date. So you will get the interest at the end of the maturity date. Insurers financial discipline as investors cannot withdraw their funds before the maturity date. Also, investors can earn a better return on investment than on ordinary savings account. The higher principal amount, the longer the investment period, and the higher interest rate offered by a financial institution. Now, boys and girls, let's look at the negatives about your fixed deposit. We know that the investor cannot withdraw their funds before the maturity date, the low returns compared to other investments, and may not outperform the effect on inflation over a long period of time. All right, grade 12s, that's it for today. Thank you so much for tuning in, and I'm hoping to see you again. From my side, thank you so much, and have a lovely weekend. Rest as we go into the weekend, and enjoy the rest of your evening. Goodbye.